what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You're listening to the Financial Survival Network and what's going on with the markets, commodities, copper just breaking out, making new lows. And are we in the era of, the end of the era of peak waste and the credit-fueled commodity bubble? Is it imploding? Well, someone who's got a lot of thoughts on that, Danielle Park, with us now. Danielle, hello.
Hello, Kerry.
Hey, so this kind of is unfolding like the way you said, Danielle, like according to your playbook here, that you had all of this free money, easy money kind of dumped into the markets, and it kept them afloat for a good long while. I mean, really, we're looking 5 years, almost 6 years. But now, it's not doing its trick anymore. Basically, the markets are in serious cold turkey, right?
Well, yes. And actually, Kerry, to be specific, the reason they came out with QE3, QE ever, whatever you want to call it, was because if you recall, 2011, commodities peaked and began to plunge. Canadian market actually was down 11%, the Canadian stock market in 2011. U.S. stocks rolled over. The S&P began to fall all the way into late 2012. So it's literally been just 2 years, really, since the fall of 12 to now that stocks were reignited, let's put it. And even so, they've been turning back down in various sectors since June. So the Fed definitely bought a rally of at least 18 more months, in my view, from where the stocks would have rolled over naturally on the weight of this business cycle, which is, reflecting slow global growth, reflecting aging demographics, excessive levels of debt. All that was pushing everything back to the downside in 2011. The Feds came out with more stimulus injections in late 12, and that succeeded in purchasing another 18 months of wild speculation and recovery in a good many asset classes. But, now here we are, the QE officially over in the U.S., announcing wave after wave in other countries. It really doesn't seem to matter because the data here is just profoundly disappointing, coming in from all over the world. And the more the weight of that builds, the more garish these valuations look on the stocks that have been pumped in the last 18 months. So I think that, there's a secular shift afoot here, twofold. Number one, primarily the U.S. dollar, which did break out above 88, which was our secular target. If it was to break through 88, it would suggest a new secular uptrend. And that happened last week. And then you had this breakdown in the commodities on the other side of that. So things like oil just collapsing, right? And commodities like copper, which has been so highly rigged and jigged and traded and manipulated and stockpiled. Honest to God, Kerry, it's a laughing stock, copper, the way it's been juiced and kept around $3 a pound, finally capitulated last week as well and broke below. So I think we're in the next phase of this, which is the recognition of how insanely priced many of these assets are.
Yeah, which just shows that the central planners can only exert so much control, so much leverage until they lose control, right?
Well, because it's a psychological impact. It is not an actual control. They have no actual impact on growth and demand in the world. All they have is add, debt, and stir. And they've been doing that for 30 years to the end point where everyone is so toxic with debt. We have more than 60 trillion globally of extra debt today than we'd had at the so-called credit bubble peak in 2007. So they've added more debt. They've suppressed the short end of the interest rate curve, all with this view that liquidity would add growth. And that simply hasn't worked. So once the belief phase ends in QE, and I've been talking about this for the past several months, that the QE belief phase was waning. And as the economic data comes in weaker and weaker and more disappointing than everyone had thought, that's when that belief phase turns into capitulation realization of, oh my goodness, they aren't actually in charge of anything. That was all a con game. And now look at we're left holding and what prices we've paid and how in the world do we justify this?
Yeah. And then the rush for the exits, right?
Well, and we've been seeing that. So it's a breathtaking, that quote I love is the crisis always takes longer to come than you thought possible and then happens so much faster than you thought possible.
Yeah.
And I think that's, it's the leverage in the system that greases the runners on this stuff. But when prices start to fall, they go at a breathtaking pace. And that's before even you had all this HFT rigging that's been going on, things like Apple yesterday dropping 3% in 1 minute. I mean, it is such a highly juiced, system today because of all the debt and all the rapid intermediaries who are just flipping in and out and trying to trade things. This is honestly the most unlike an investment climate or investment markets than one could ever get. We have turned the capitalist blood flow of supposedly investment markets into the casino of the Wild West. And it has nothing to do with investing today. It is an absolute disaster as far as that goes. But the good news is that these unsustainable periods always come to an end. And I think that that's in the works at the moment.
Yeah, just for those of you out there who don't know the difference, Danielle, what is the difference between a speculation and investment? What's the difference between them?
Okay, so investment is a math-based exercise. It looks at cash flows that will be coming in the future that are reasonably predictable. Not you might win the lottery, but reasonably predictable, prescribed by law if possible in the form of interest payments by way on debt payments that you're owed on bonds or deposits by dividends that have been promised. Now, dividends are never etched in stone. They can always be canceled by management where necessary because they come out of net profits. So if there's a problem with net income, they can cut back dividends. But basically, it's a mathematical calculation that gives a present value to those future cash flows. And if that value is where that asset is trading, or indeed if that asset is trading for less than the total of that future value, then you have an investment on your hands. Then you have a reason to buy something, to part with cash on the reasonable probability that you're going to have a significant reward or a worthwhile reward over time. A speculation, generally speaking, pays no attention to math, doesn't care at all about income, because when they do the math on the prices they're paying, it makes no logical sense, right? They're paying, for example, 25 times earnings, or today 27 times earnings on a Schiller PE. So that's the future cash flow, or the cash flow that you can reasonably, average cash flow over the last decade, and you put a factor of how many times you're prepared to pay for that to get that cash flow. When you're paying these levels, it makes no sense. You've got a duration of 50 years to try and get your money back. So that's when you know you're in a speculative environment, because no one's doing math and everybody's buying things because on their logic is, well, I'll be able to sell it to someone else at a higher price. And if that's your only reason for partaking in a security, then you're doing so on a speculative whim or window or hope.
That's like kind of the greater fool theory, if you will, right?
Yeah. And sometimes you get lucky if you're doing that. You can get lucky and get a pop in price, but then you also have to realize you were lucky and sell to capture that cash flow. Most speculators are not aware that they're speculating. They think they're investing. So and if they have some early success, they get particularly encouraged and emboldened and aggressive, and that therein lies their own demise, right? The more aggressive you get when the odds become worse and worse and less in your favor, the more likely you're going to completely implode and go back to zero. So if you look at, Kerry, on our blog, we have a chart that the commodities index since 2006. If you see, that's some of my partner Corey's work. But there's a speculative frenzy in motion. Okay, so you see from 06 to 08, the way that index, that's all the, we did one on all the companies as well as the commodities themselves. But basically, about 2006, we went into full speculative bubble on that, where, you left that band of relative value there, the gray band on that chart, and you went into, higher and higher prices, parabolic moves. And the more that price moves up, of course, the greater the story, and the more people begin selling the story, and the more people buy in, the more greater fools are found. Let's put it that way. But then because they don't realize they're the greater fool, they don't realize they're not doing any actual investing, they're just riding a bubble, they stay in, and then it collapses of its own weight. And that's what you see in that chart. Now, an interesting thing, and this is why I talk about secular boom cycles as being so important to recognize, because once they peak and collapse, they tend to revisit their prior low. So as if that whole boom didn't happen. Like it literally goes right back down to before people even got interested in the space. We saw that with the tech bubble in 2000 when things imploded 70% and we're back to where they had been more than a decade before in terms of values. And you're seeing that in the commodity space today. So that whole sector has basically gone back to the lows of 2009, which happened, by the way, to be about where they were in 2000 before the whole frenzy took off. So that's why it's important to understand the climate you're in and the logic you're parting with your capital on. If you know that you're speculating and you take a limited percentage of your funds and I say, figure out what amount of money you could afford to lose at the casino this weekend. Mm-hmm. If you want to pair that off and swing for the fences, that's fine. But don't call that investing, right? Call that speculating. Do yourself a favor. Realize what you're doing with that money. And with the portion of your life savings that you wouldn't take to the casino, that's where investing comes in. That's where you actually have to have restraint and discipline and care about what price you pay for things. And the reason that I have such a revulsion to the financial industry is that, especially in periods like now in 2000, 2007, because we've been going through this frenzied bubble period for the last 15 years with these profound parabolic moves and collapses, they basically have abandoned all guise about it being investing, although they still say that they're investing, although they still say that it's skills-based or intelligence or education-based. It's actually nothing to do with that. It's a complete free-for-all of people grabbing fees for whatever they can get as prices go up. And then as soon as the plunge and collapse comes, they stand back and say they weren't responsible. They didn't, they didn't know. They were just selling you stuff. Everybody got hurt. All this nonsense that people say to, show that they actually had no skin in the game or no responsibility for the outcome. So I just spent a lot of time trying to educate people on the difference of those two pursuits.
It's so profound, the difference between investment and speculation. You go back to Benjamin Graham, who's the father of securities analysis, the modern, he's really, everything started with him more or less, all balance sheet, financial, analysis. And it was strictly a matter of cash flow and future dividends. And, he gave a definition really similar to what you just did. And, it's not just, you're not just looking at publicly traded markets. You could make the same argument about real estate in New York City and in the go-go markets in the United States. Right now, the hottest real estate market in the U.S. and arguably in North America and perhaps the world is Miami. It's taken over for New York, and it's trading on a basis that has nothing to do with cash flow, with underlying value of the property. It's strictly a matter of how much money somebody is willing to pay for a piece of property, right?
Yeah. And you see, what happens is because these bubble phases or illogical math phases can go on for several years. The longer they go on, the people that know the least, don't know the right questions to ask, and are completely oblivious to the risk, start to look like they're the smartest, right? The most reckless participants begin to look like they're the smartest. And that's the most devastating thing. So people start to follow the most reckless players just because they appear to be having great success. but the mean reversion periods are so extreme that when they come, they wipe those people out completely. So you go from 100 back to 0, and all of a sudden the people who didn't appreciate they were following the wrong people are left devastated and sometimes can't recover. And that's very common. It takes years to recover. So it's the lure of easy money. And if you can participate in bubble prices, as I say, with very strict rules on what you're speculating with, and if you can define your quantity and maybe a goal target or duration, whatever it is, if you can define some rules around it, then, by all means, swing away, buy lottery tickets too while you're at it. But, with the money that you literally cannot afford to rebuild because it's a bulk of your savings, or you're getting on in life, or you're coming towards retirement. I mean, it matters if you're paying, prices that are very unlikely to be rewarding, or that you will likely have to hold for 50 years to get your money back. I mean, if the thing doesn't go bankrupt altogether, which means there's no chance you'll get your money back. Another really important sector, Kerry, is the high yield debt market. Now, you and I have talked about it several times, right? And what really struck me is, as someone who was watching the horrifying trends in the high yield debt market in 2006-07, when the whole housing subprime nonsense was being packaged and sold off to unsuspecting people, debt went to these crazy levels and then collapsed. So that was actually at the very beginning of the bear market in stocks. Debt collapsed in the fall, in sort of November, December of 2008, when stocks didn't bottom until March, a few months later. But the high yield debt market began to collapse, and it dropped about 30% in price, those bonds, before they actually caught a bid again and were able to provide good value. Now, we actually stayed out of them at those ridiculous valuations because it looked like fun for those participating, but it made no mathematical sense. Then when the thing collapsed, we were able to step in and buy some of the packets of high yield bonds at this 30% discount, where the yields were actually higher than 10%. So this is the other advantage to not being sucked into paying too much for something. When you wait for price discipline to return, you actually get this much higher income, which again makes sense. It rewards you for the risk of buying the asset in the first place. So a story caught my eye, with the plunge in oil recently, how, it's taken many people off guard because they weren't thinking of this as the great deflation following the credit bubble, when everything has to basically come back down in value back to affordable levels because the world can't keep using debt and debt and debt to purchase this stuff. So you get asset deflation. So that's happening in oil right now. And it's been a very dramatic decline, as these things often are when they're full of great leverage. But the high yield debt market, so the yields in the energy space have been widening very significantly in the past few weeks, which means people are starting to sober up and think, wait, if oil has plunged more than 35% in the past 3 months, then that means profitability is eroding at a rapid rate at many of these firms. Guess who's been issuing the lion's share of the high yield debt in the past couple of years, Kerry? It's the energy sector. Wall Street and Bay Street have been underwriting tons and tons of this paper at extraordinarily low rates of interest as part of this whole credit bubble phenomenon. And now with the plunge in price, we know that something like 40% of the energy sector is likely to default on those debts, or those debts are likely to see a default rate over the next couple of years of up to 40%. And that's if the price of oil stays roughly here, Kerry. If we're talking about mean reversion like we saw in the venture and some of these other mining minerals companies, you could see a reversion back to $40 a barrel, which is where oil broke out into the secular climb that we saw into 2008 peak, and then a rally into 11, and then now it's been coming down ever since. But if that's the case, then the default rate in this sector could just balloon out again, which could provide awfully wonderful opportunity for those of us who are inclined to invest as opposed to just run the tables. And so that's the kind of opportunity that I've got my eye on right now, because I think it's getting to be a very interesting secular shift here. As I say, I believe this is coming into the next cyclical downturn, next bear market. And most importantly, because the policy tricks have all been tried, I don't see this as a V-shaped recovery coming out of the next cyclical bottom. And that goes back to he and she who has cash to buy things at mathematically attractive rates, once these price declines have happened, will be getting good income flow with a fraction of the risk. And that's how you catch up so quickly over the speculators.
Yeah, and let the speculators take the risk, and then you sit back, wait for the thing to blow up, and then you go bargain hunting and find the things that really have secure cash flow that's protected as best as it can be in this day and age. And you cash in, and yeah, it just makes so much sense.
And also, you'll know you're at the bottom of it when you get to a surrender phase where people are no longer wondering when they should buy the next hot, energy sector, next hot stock. When people are talking about, get me the hell out. I want nothing to do with equities. This is how secular bears end. They end in revulsion, where people don't want to go near the sector or the asset class for years thereafter. That's exactly what happened coming into 1980. Into the final throes of the 66 to 82 bear market. People had pension funds had left equities. Everybody had left equities. They considered them to be highly speculative and highly manipulated. Kerry. Yeah. So I think if you think about that, we're coming to a time when you can't read a newspaper or a news service anywhere where you're not seeing 5 and 6 and 7 stories about manipulation, improper activity, basically abuses of every kind. So I think we are coming into the phase where people are believing that equities are a highly manipulated, highly rigged, and not something you use for investing. But we're not quite there yet, because we still have this huge industry that are paid to sell risk to everybody, who are populating the airwaves, controlling the message, and keeping telling everyone that brainwashing statement that they're the investment gurus, and that they knew prices would go up like this. And it's crazy.
Yeah, the all-knowing, all-seeing, brilliant ones among us, right?
And then they never know when prices are going to go down, right? They say that's not possible to see, but it is actually possible to see. And actually, the math of loss is such. Gary Schilling's book, The Age of Deleveraging, I was just rereading parts of it again last night at the gym when I'm on my bike. But basically, he's just reminding that, the collapse and everything that comes is what provides all this great opportunity. And it's just, people have to want to understand the difference between speculating and investing, and they can't be in a big rush all the time.
Yeah, and that is the problem. Everybody's in a rush, and, you just have to be able to sit back and let the returns accrue to you. And hey, I remember before the big bull market started then, there were some real values where you could be making like huge dividend returns.
Well, you found that in 2002-3, there was a great window there, and there was a nice low ramp off the bottom in Feb 03 when it finally started to get traction. Stocks were a decent opportunity valuation wise all the way into 2005. And then they started to get a little pricey by late 05. By 06, 07, they were just ridiculous again. And then they had their mean reversion into 09, and we got that window again. But the problem is it was a quick V recovery. Within months, the valuations had already gone offside again, and really not a very favorable investment environment. So, I think what we're going to see here is we're going to see most of these assets mean revert to where they were in 2009. And the big question is this: will that be sufficient? You and I were talking about this earlier. So we know there was this big bubble peak in 07 that collapsed things back to 12-year lows when they finally hit in 09. Then you had massive stimulus and intervention to try and revive things quickly. And they did get a big rally off the bottom. But essentially, this time, if the weight of these things mean revert because the overall economy is weak as it is, and all the data, the PMI optimize. Everything's coming in to be in contraction mode of late. If that's the phase we're at now, just think about how much lower some of these assets could go. Things like the S&P, which maintain themselves right now, near a record high, decoupled from the Russell 2000 and all the other things that actually matter in the economy. That gap, once it comes back down, what will the liquidity be the next time? Where will it come from? Where will the belief be? When we've already shown that QE is a farce and doesn't actually revive the economy. So I think that the next bottom could be a much more durable, slow recovery phase, which again will matter so much what you pay for those assets. Because if you wait and buy them after they've collapsed and you're getting a great income flow off them because of that, then you're going to have patience to wait for years while the system kind of reboots.
Yeah, I think you make such a wonderful point there. And, this is just like the cycles that bring the markets up and bring them down, this cycle of investor sentiment and appetite for risk or blindness to risk. That goes on over and over and over again. We keep seeing it. Nothing ever changes here, Danielle, except you and I. And on that note, find Danielle's work at jugglingdynamite.com. And we've always got a link in the show notes to every interview. So just click it. And while you're in financialsurvivalnetwork.com, sign up for a newsletter. Danielle, we'll talk to you in a couple of weeks, but it's unfolding pretty much according to plan, isn't it?
Yes, sir. I don't want to be cocky, but I'm hopeful.
All right. We'll talk to you in a couple of weeks. Thanks.
Thanks, Kerry. Bye-bye.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.